Welcome, everyone, to the Gold Talk Show. This is your YouTube channel for, well, really getting into the details, the deep analysis on all things gold.
That's right. Glad to be here.
Today, we are really diving deep. We're looking at what some people are calling a pretty critical moment for anyone invested in gold or even just thinking about it.
Absolutely. We're going to unpack some really compelling analysis about where the gold market is right now, what's driving things, what might happen next, especially, keeping an eye on the U.S. Federal Reserves.
Yeah, the Fed always looms large, doesn't it? So, okay, this deep dive is about understanding the current picture and maybe the potential future for gold. Let's just jump right in.
Let's do it.
So the analysis we've looked at, it puts forward this idea that the current situation, it might be genuinely rare, like maybe a once in 20 years kind of opportunity. Is that overstating it, or?
Well, look, the argument isn't just about a simple price jump. It's suggesting that the underlying economic conditions we're seeing now, they echo periods that came before major shifts in gold's value.
Okay, so not just noise, something bigger.
Potentially, yeah. For you, our listener, trying to, quickly grasp these big market shifts, this is definitely something to pay attention to.
And to help understand why, the analysis makes comparisons to the past, specifically 2008, the global financial crisis, and 2020, the start of the pandemic. Let's tackle 2008 first. What was the pattern with gold back then?
It's really interesting because initially in 2008, huge stress in the financial system, gold actually sold off first. People wanted cash. Liquidity was king.
Right, that dash for cash.
Exactly. But that didn't last long. As the Fed and other central banks started slashing interest rates basically towards zero, gold began this massive climb. It went from under $800 to over $1,900 in about 3 years. It really acted as that safe haven, that store of value when money policy got super loose.
Okay, so initial dip, then a huge surge driven by policy change.
Yeah.
In 2020, do we see a repeat?
Very similar pattern, actually. The pandemic shock hits, markets go into turmoil, gold sells off briefly again.
That need for liquidity again.
Precisely. But then the Fed unleashed enormous amounts of quantitative easing, just, pumping money into the system.
Like gold.
Responded immediately, shot up fast, went past $2,000 an ounce. So these examples, they really show a potential cycle. Crisis hits, maybe a brief gold sell-off, then monetary easing kicks in, and gold tends to perform very well. Understanding that for you is valuable context.
Okay, context established.
Yeah.
So fast forward to now, 2025, the analysis points to similar signals emerging. What are the key things they're flagging right now?
Well, they're looking at things like negative U.S. economic growth figures, consumer confidence starting to wobble, inflation that's still, sticky, proving hard to tame, and then weaker job reports like the non-farm payrolls, the NFP numbers.
And the recent price action.
Yeah.
Gold surged, then pulled back sharply. How does that fit in?
Yeah, that's a key point. The analysis suggests not necessarily seeing that pullback as like the start of a big downturn. Instead, it's interpreted more as a strategic pause. A pullback. Maybe, just maybe, a chance for the bigger players to accumulate before another potential wave up.
A strategic pullback. Interesting phrase. What makes them think that rather than just, the trend ending?
Well, after a strong run-up, like the 7% gain we saw in April, according to the source material, a technical correction isn't unusual. It sort of shakes out the weaker hands, allows for some profit taking. The argument is, if this correction happens on maybe lower volume, or if the price finds strong support quickly, it could signal that larger institutions are actually stepping in to buy the dip, anticipating longer-term strength.
Okay, that makes sense. And central to all this, as you mentioned, is the Fed. Their role seems critical. The analysis really hammers home the difficult spot they're in. Can you unpack that dilemma?
Yeah, they're really walking a tightrope. On one hand, they need to control inflation. That's been their mandate. High interest rates are the main tool for that, to cool things down.
Yep.
But if they keep rates too high for too long, they risk tipping the U.S. economy into a serious recession, a hard landing.
Okay.
On the other flip side, if they cut rates too soon, before inflation is truly beaten, they risk inflation flaring right back up again.
So damned if they do, damned if they don't, almost.
Pretty much.
Yeah.
And the analysis suggests that the weight of the incoming data, like that Q1 GDP showing a contraction, minus 0.3%.
Yeah, that was notable.
And the lower NFP job number in April, only 62,000, plus CPI inflation still sticking around 3.7%. All this economic pressure is building. The expectation is that eventually the Fed's hand will be force. They'll have to pivot policy.
A pivot towards easing, lower rates.
That's the anticipation. And the idea is that the smart money, the big institutional investors, they see this coming. They're positioning themselves now, accumulating assets like gold before that policy shift actually happens.
It's always fascinating how these big players seem to move ahead of the news. What kind of indicators are they watching besides just the headlines?
They're digging much deeper, looking at a whole range of macroeconomic data, not just GDP and jobs, but manufacturing surveys, consumer spending, credit markets, all sorts of things.
Right.
They track fund flows very closely. Where is money moving? Are big sums flowing into gold ETFs, for instance? Even if the price is down slightly, that's a potential clue.
The ETF flows. Yeah.
And the bond market is crucial. Bond yields react instantly to changing expectations about growth, inflation, and Fed policy. So they watch that like a hawk.
So the whole dashboard of signals, not just one thing.
Exactly. And things like the CME FedWatch tool, which basically tracks the market's bets on future Fed rate moves. That's another piece of the puzzle. If the probability of a rate cut starts ticking up, that reinforces the narrative.
And that recent gold sell-off coinciding with the dollar getting stronger.
Yeah.
How does that fit?
Well, gold and the dollar often move inversely, right? So a stronger dollar can put temporary pressure on gold prices. Seeing gold pull back when the dollar rallies could be seen by some as part of that accumulation phase we talked about. The big players may be using dollar strength as an opportunity to buy gold cheaper. It's complex. You have to look at all these interplaying factors.
Okay, so let's bring it back to that specific price drop we saw recently, from around $330 down to $3,230 or so. How should someone listening interpret that based on this analysis? Just a blip.
The perspective offered is, don't necessarily panic. Don't see it as a sign the whole bullish case is broken. After a big run, like that 7% jump in April, a pullback, a consolidation is technically healthy. It digests the gains, gets rid of some short-term speculation, and potentially builds a stronger base for the next move up.
So it could be just market mechanics at play.
That's the argument. It's seen as potentially strategic. Big players might even contribute to the selling at the highs, only to buy back lower when sentiment gets a bit more fearful or uncertain, especially when you have mixed economic data and dollar strength muddying the waters short term.
So the key is looking through the short-term noise to the potential underlying trend and the actions of those big institutions.
Precisely. It's about interpreting the data and, importantly, the behavior of that big money, not just staring at the price chart itself. Are they accumulating on these dips? That's the question.
Got it. Okay, the analysis then helpfully lays out three potential scenarios, specifically around the upcoming NFP jobs report. This helps frame potential short-term moves. What's scenario number one?
Scenario one. The NFP report comes in weaker than expected.
Meaning fewer jobs created.
Right. That would signal the economy is slowing more significantly, which in turn would likely increase market expectations that the Fed will have to turn dovish, signal rate cuts are coming sooner rather than later.
And the expected reaction in gold.
Likely positive, potentially a sharp move upwards. The action plan suggested here is be ready. Have your entry points figured out beforehand, maybe above key levels like $3,300, $3,350, have your capital allocated. And crucially, have your risk management, like stop losses, in place.
Okay, prepared for a positive reaction.
Yeah.
What's scenario two?
Scenario two. The NFP report is strong, better than expected, lots of jobs created.
Good news for the economy, maybe not so good for gold short term.
That's the thinking. A strong report gives the Fed cover to stay hawkish, to keep interest rates higher for longer to fight inflation. That could put downward pressure on gold prices in the immediate aftermath.
So the action plan then?
Observe. Watch key support levels, maybe $3,200, maybe lower. Look for signs that buyers are stepping in despite the strong data. Are the big players using this dip to accumulate strategically? And remember, one strong report doesn't necessarily erase all the underlying economic concerns.
Right. Keep the bigger picture in mind. Okay, and the third scenario?
Scenario three. A neutral report. Basically, NFP comes in right around expectations. No big surprises.
So, market reaction.
Likely more muted. Gold might just trade sideways, kind of stuck in a range between support and resistance levels.
And the plan.
This is where established trading models might come in, trying to capture smaller swings within that range. But the emphasis is really on risk control. Preserve your capital. Wait for a clearer signal, a stronger catalyst. The main point across all three is, if you're prepared to the plan, you can react logically, not emotionally, whatever the number is.
Preparation is key. That leads nicely into the final part of the analysis. We've talked about, well, accumulating gold like sophisticated wealthy investors do. What's the mindset there?
Yeah, the core idea is moving away from reactive buying, like chasing news or getting FOMO, fear of missing out.
Right.
It's about having a proactive plan, identifying when to buy, deciding how much capital to allocate, and crucially, maintaining emotional discipline throughout the process.
Okay, so when is the right time according to this view?
Often, it's during times of market fear or correction, when prices pull back and test those technical support levels we mentioned. The recent dip towards $300 and $230, for instance, is presented as potentially one of those moments, a reset, an opportunity if your analysis aligns.
Buying when others are fearful, essentially. And the capital allocation part, how much gold?
The analysis gives some very general guidelines, and these really depend heavily on your own situation, your age, your overall financial goals, how comfortable you are with risk.
Sure, standard disclaimer.
Absolutely. But, for example, it might suggest someone younger, under 30, maybe considers 10-15% in gold. Someone in their middle years, 30-45, perhaps 20-25%. And for those older, over 45, maybe closer to retirement, it could be higher, 30-40%, or even more. But again, these are just broad strokes.
Just illustrative numbers.
Got it.
And the emotional discipline. That sounds like the hardest part.
Oh, it absolutely is. Resisting the urge to panic sell when prices dip or greedily buy more at the very top. It's tough. Sticking to your preset plan, your entry points, your stop loss levels to cap losses, your profit targets. That's what separates disciplined investing from gambling, really.
Easier said than done.
Way easier said than done. But the source emphasizes that consistent, rational action based on your plan is ultimately what can lead to, extraordinary results over time. The final message is really, consider starting that intelligent accumulation now, before the potential Fed pivot potentially sends prices significantly higher.
This has been incredibly illuminating. Really unpacked a lot of layers to the current gold story. Definitely gives our listeners plenty to think about.
I hope so. Yeah, understanding the history, the current pressures, the potential Fed moves, it's all crucial for anyone trying to navigate the gold market right now.
Well, that wraps up our deep dive for today here on the Gold Talk Show. A big thank you for joining us. If you found this discussion helpful, please do give us a like, share the video with others who might be interested, and definitely subscribe to the channel. We'll keep bringing you these in-depth analyses on gold.
Absolutely. And just a final thought to leave you with. Often, the biggest opportunities arrive when most people are feeling the most doubt or uncertainty. Could this be one of those moments for gold? Something to consider.